Hello, everyone, and welcome. Today, we're going to tackle a topic that's absolutely central to Canadian tax and estate planning, the trust. We'll be breaking down exactly how trusts are taxed, the key strategies for managing that tax, and some of the critical rules you absolutely need to be aware of. All right.
Okay, so here's our roadmap for today. We're going to break this down into 6 main areas. First, we'll start with the most fundamental concept, how a trust is viewed as a taxpayer. Then we'll get into the nuts and bolts of calculating its tax. After that, we'll explore the essential strategy of allocating income. From there, we'll dive into the tricky 21-year rule, look at the very important special cases of spousal trusts and estates, and we'll finish up with a quick look at some other common trust types.
Right, so our first step is to understand how the Canada Revenue Agency, or the CRA, perceives a trust. Honestly, if you can grasp this one single concept, everything else that follows will make a lot more sense.
So here it is, the most crucial point. For tax purposes, a trust is treated as if it were an individual person. It's a distinct, separate taxpayer, just like you or me. It's not a company, it's not a partnership, it's an individual. Forgetting this simple analogy is probably the #1 mistake people make. Just remember, it's its own entity that files its own tax return.
And this idea of being treated like an individual extends to its key features. For example, a trust's residency isn't based on where the beneficiaries live, but on where its central management and control is located. Basically, where are the trustees making the important decisions. And, perfectly in line with being treated as an individual, a trust's tax year is always the calendar year, running from January 1st to December 31st.
Now that we've established a trust is a taxpayer, the next logical question is, how do we calculate the tax it owes? And this is where things get really interesting, because we run into a major challenge, but also a major planning opportunity.
Unlike an individual who gets the benefit of graduated tax brackets, most trusts face a pretty steep climb. Any income that is kept inside the trust and not paid out gets taxed at the highest personal marginal rates in the province. Just look at these numbers, a staggering 50% on ordinary income, 25% on capital gains. These incredibly high flat rates create a massive incentive to not let income build up inside the trust.
So you see the problem, right? Leaving income in a trust is incredibly tax inefficient. This naturally leads us to the big strategic question. What are the solutions? How can we manage this? Well, there are 2 main ways to go about it. The first path is to see if the trust qualifies for a special exception. You see, only 2 specific types of trusts are allowed to use the same graduated personal tax rates that you and I use. The first is what's called a graduated rate estate, or a GRE. That's an estate for the first 3 years after someone passes away. The second is a qualified disability trust, or QDT, which is set up for a beneficiary who's eligible for the disability tax credit.
Just look at the difference here. The contrast between these graduated rates and that flat 50% top rate is just night and day. For a graduated rate estate or a qualified disability trust, you can see that the first, say, $57,000 of income is taxed at a much more reasonable 20%. Having access to these lower tax brackets is a huge advantage and a cornerstone of proper estate planning.
This example really shows you the power of income splitting when you have one of these trusts. Let's say a graduated rate estate earns $60,000 of income. It doesn't have to pay tax on that entire amount itself. Instead, it can keep $20,000 and then allocate $20,000 to beneficiary A and another $20,000 to beneficiary B. What you've just done is create 3 separate taxpayers, each with a small amount of income. By spreading that $60,000 across 3 different sets of low tax brackets, the total tax bill goes down dramatically.
And that leads us perfectly into the second, and by far the most common, strategy for managing a trust's tax bill. And that is simply allocating the income out of the highly taxed trust and into the hands of the beneficiaries.
The process itself is actually quite straightforward. Step 1, the trust earns some income. Step 2, the trustee decides to make that income payable to a beneficiary. That just means the beneficiary now has a right to receive it. Step 3, the trust gets to take a deduction for that amount, which lowers its own taxable income. And finally, Step 4, the beneficiary gets the income and reports it on their personal tax return, where it's taxed at their own marginal rates, which of course are almost always going to be lower than the trust's top rate.
Now, here's a really crucial detail in this process. It's called the flow-through principle. What this means is that the income keeps its original character, or its flavor, as it passes through the trust to the beneficiary. So, for example, if the trust allocates a capital gain, the beneficiary reports a capital gain. If it allocates an eligible dividend, the beneficiary reports that same eligible dividend and gets to claim the dividend tax credit. This is a great feature because it ensures that all the preferential tax treatments for different types of income flow right through to the beneficiary.
All right, we're now going to shift gears to a more complex but absolutely critical rule in trust taxation. You see, unlike a person with a finite lifespan, a trust could theoretically exist forever. And to prevent that from being used to defer taxes indefinitely, the government put a very powerful anti-avoidance rule into the Income Tax Act.
In the world of trusts, 21 is a really important number. Any idea why that might be?
It's all because of something called the 21-year rule. On the 21st anniversary of its creation, and then again every 21 years after that, a trust is treated as if it sold all of its capital property for whatever it's worth at that moment, its fair market value. This is called a deemed disposition, and it forces any built-up capital gains or recapture to be realized and the tax to be paid. It's the government's way of simulating the tax event that happens when an individual passes away.
Let's just walk through this example to see how it works. For the land, the trust is deemed to have sold it for $70,000. We subtract the original cost of $50,000, and that gives us a $10,000 taxable capital gain. Now, building number one is a bit more complex. It triggers both a capital gain and what's called a recapture of depreciation that was claimed over the years. You can see how this rule can create a massive tax bill out of thin air, which is why trustees have to plan for it years in advance, often by distributing assets before that 21-year clock strikes.
So, we've covered the general rules. Now let's zoom in on two of the most common and important special cases that you'll encounter in practice: spousal trusts and estates.
A qualifying spousal trust comes with three incredibly powerful tax advantages. First, when assets are transferred into it from a deceased person, they can go in at their original cost. This is a tax-deferred rollover. Second, that 21-year rule we just talked about, it gets waived. The big tax event only happens when the surviving spouse passes away. And third, when that spouse does die, the resulting income is taxed on their final personal tax return, which means it gets access to their graduated tax rates.
An estate is, for tax purposes, the very first trust that's created when an individual dies. As you can see from this flowchart, it acts as a kind of temporary holding entity. During this administrative period, the executor's job is to gather up all the assets, pay off any debts, and then distribute whatever is left over, either directly to the heirs or into new testamentary trusts that will continue on. The whole time, the estate is being taxed as a trust.
And this is where that 36-month window becomes so important. For its first 3 years, an estate gets to be a graduated rate estate, or GRE, and use those fantastic graduated tax rates we talked about earlier. But, and this is critical, exactly 36 months after the date of death, that special status ends, period. The trust has what's called a deemed year end, and from that day forward, it becomes just a regular testamentary trust, and it gets slammed with those high tax rates and a mandatory calendar year end.
To wrap things up, let's just do a quick run-through of a few other specialized types of trusts that you're likely to come across in Canadian tax and estate planning. First, we have alter ego and joint partner trusts. These are mainly for people over 65 who want to manage their assets and avoid probate fees when they pass away. Then there's the bare trust, which is a very simple arrangement where one person just holds the legal title for another. For tax purposes, the CRA basically looks right through it, and all the income is taxed to the real owner. You're also familiar with unit trusts. This is the structure used for mutual funds and real estate investment trusts, which are designed to just flow income out to investors. And finally, of course, are the trusts that hold our registered plans like RRSPs and RESPs, where the whole point is to defer tax on the growth until the money is taken out. So as we've seen today, trusts are an incredibly versatile tool, but they're also governed by a really complex set of rules. From using GREs to manage tax, to allocating income, to deferring gains with spousal trusts, and planning around that 21-year rule, the possibilities are really vast. And that leads us to the final essential question. Which of these intricate structures is the right one for any particular financial goal? And the answer, of course, always lies in careful professional planning.